Good morning, everybody. It's Monday, April 20th. I just wanted to take a minute and pass along an update on the mortgage market. If you're receiving this, you have sent us a mortgage statement in the past 30 to 60 days, and a lot of you I've spoken to already, but a lot of you are still patiently waiting to hear back from me, and I thank you for that patience. We have received a record number of requests, literally thousands of our clients have sent in mortgage statements requesting math and benefit calculations. So we're doing the best we can to work through the demand. We are working from limited capacity right now, all of us working from home, but we are getting through it. Also, just wanted to share that time's on our side right now with respect to the market, and I'll give you a little insight into the strategy that we're employing. I'll give you a little update on where the market is at the moment. So I'm going to share my screen with you for a second and just show you a visual. Sometimes a picture is worth 1,000 words. So this is a picture of the Fannie Mae 2.5% coupon. This is live bond pricing that I watch every day. And just to give you some background, okay, when a lender, when we write your mortgage, we don't have an endless supply of money to make loans for every American and every client that we deal with. So we write the loan, we then sell the loan back to Fannie Mae and Freddie Mac, okay, and we get our capital back to make more loans for more Americans. So we're recycling our money through the government agencies, Fannie Mae and Freddie Mac. Now, Fannie and Freddie are taking the mortgages and securitizing them into bonds. And these bonds get traded on the open market. They become part of investment vehicles all over the world, pension plans, retirement funds, etc. Okay, so what we're doing as a servicer is collecting the mortgage payment and passing the principal and interest on to Fannie Mae, and also the interest is then going out to the investors that own the bonds that your mortgage is a part of. Okay, so it's a key role of what we do. So those bonds control interest rates, and that's what we're looking at here. So this is a one-year view of the 2.5% bond. Okay, it shows price. The higher the price, the lower the interest rates, and the lower the cost of the interest rate. So we want to see things improving. So overall, the past year has been good. We see bond prices improving. There's this period right here, which I'm going to talk about, and I'm going to zoom in on that period right now. That's the past 6 months. Okay, so in normal times, bond prices move in very small increments. They move up and down every day. Green days on the chart are bond prices moving higher. And what we would normally try to do is time interest rate locks with peaks in bond price, right? When bond prices hit the top, we try to lock rates because rates are at their lowest, prices are at their lowest. And then when things start to go south, we float the market and we wait for the next bounce. And we would look to lock on days like this when bond prices peak. And in normal times, there are subtle movements day to day in bond price. So as we move through the year, again, this is going from October 2019 all the way through December into January 2020 into February, you can see that bond prices had slowly started improving. Slowly but surely, the trend was for increasing prices and dropping rates. And at this time, a lot of people started refinancing, and we launched a campaign to let you know that there was an opportunity to refi. Probably made sense. And we were doing very well. The economy was moving 100 miles an hour. And then all of a sudden, we got to March 9th. March 9th, we essentially pulled the emergency brake on the economy. And this was when COVID-19 became a real issue. And we went from 100 miles an hour to zero, and the wheels fell off the bus, so to speak, in the mortgage market. You can see that over the next few days and weeks, we had a massive drop in bond price. Things normally don't move this much in the bond markets, but we saw interest rates basically fall 1.5 points within days. And then we moved into this period of chaos, I call it right here. This is basically the 2 weeks after March 9th, where financial markets were just trying to make heads and tails of what was going on. There were a lot of fears about the overall economic health. We shut the economy down. We had people losing their jobs. We had projected record high rates of unemployment, which we're dealing with now. And on top of that, we also had the forbearance crisis, which I'll share with you a little bit about in a minute. But ultimately, understand, as a lender, okay, we are collecting mortgage payments for people. And if all of a sudden homeowners don't make those mortgage payments, we still have to deliver the interest to Fannie Mae and Freddie Mac and to the investors that own the bonds that the mortgages are a part of. Okay, we're guaranteeing that interest as a servicer. So if all of a sudden homeowners aren't making their mortgage payments, then our cash positions start to diminish because we have to guarantee and make those payments. So that's a big concern, and we have some reserves, obviously, to handle in normal times a few people not making their mortgage payments. But when millions of people are on the verge of not making their payments, this becomes a big problem because we don't have an endless supply of cash. The other thing to understand about this period here is that mortgage companies not only originate loans and sell them to Fannie Mae and Freddie Mac, but they also buy loans from other banks, right? We're constantly buying and selling loans, acquiring large pools of loans to service, right? When we collect a mortgage payment, we take 0.25% of the interest, and we pass on 99.75% to the investors. We do that millions of times over. So when we buy these loans, we're buying them a lot of time on margin, again, because we don't have enough cash to do it. So our institutional investors that we borrow from are also paying attention to our books and our reserve position. We have to have so much in reserve in order to borrow this money. Well, when our reserve balances fall, these institutional investors place margin calls upon us, and they want their money back. So now we have a problem that's twofold. We have homeowners who are potentially not going to be able to make their mortgage payments, and now we have our reserve balances falling, and we also have our investors who are requesting their money back. So our cash balances can become very diminished, and we can ultimately become insolvent and go out of business. Okay, couple that with the forbearance program, where you have the federal government stepping in to try and help homeowners, which is a great intention. But if the government is basically telling homeowners not to make their mortgage payments, it exacerbates the problem, and our cash reserves fall even lower. So this is a big problem for the mortgage lending industry right now. And as a result, banks are basically tightening up their guidelines and effectively keeping rates higher than where they should be. If you look past the past few weeks, we get into this period here, which is literally last week and the week before, you can kind of see that the chaos has settled down. Now, this is a direct result of the Federal Reserve stepping in and starting to buy mortgage bonds. They did this intentionally to settle the market. And they didn't just buy a few mortgage bonds, they just came in and started buying all of them. And so when the Federal Reserve does that, it stabilizes the market, and it also basically keeps bond prices at record high levels, which would normally translate to record low interest rates. But because, again, of the forbearance crisis, banks are scared right now, and they aren't responding with the interest rates that we would expect to see. We're keeping rates slightly elevated until we get some more clarity on the forbearance issue. So for right now, we're in this range, and we're trading in a relatively normal fashion again, which is good. But what we want to see is pricing start to come back. So we are going to potentially float the market for now. We're going to take applications over the next coming weeks, get the paperwork approved, get the applications approved, and just sit on the approvals and wait for this pricing to come back. This is a game of patience. Okay, refinancing is not like purchasing a home. You don't have a closing date that you have to hit and close by. So we can float the market and wait for the best opportunities to present themselves, and we think that those opportunities are going to start to show up in the month of May and beyond. So again, I know a lot of you are waiting to hear back from us on the math. We are going to get to you. Definitely feel free to call me or email me if you have urgent questions. But understand that right now, we do have a good handle on the market. We do see interest rates improving over the next coming days and weeks, and we are making an effort to float all of our applications into the month of May. So time is on our side. Patience is going to pay dividends here. And I hope that helps clarify a little bit about what's going on. And again, thank you for your patience. I appreciate it. I will be in touch soon. Okay, and enjoy the rest of your Monday. Take care.